What is going on, guys? Welcome to Delta Rules. In this video, I have something special for you. I figured I did an options course for you guys out there that are trying to invest in options but either don't know how to do it or have a basic understanding but haven't gotten the grasp of it completely. I will be posting more videos like this with a highly organized set of courses discussing options from top to bottom. The more I go into the courses, the more advanced the content will get. Now, I promise you, if you stay with me and show me some dedication, you will understand like the back of your palm. Now, in our first video, we will be going into what are options. I'm going to give you guys a basic understanding as far as to what they are and how they work. Now, please keep in mind, the opinions and ideas presented by Delta Rules and myself are for informational and educational purposes only and should not be constructed to represent trading or investment advice. None of the information on this channel constitutes a recommendation that any particular security, portfolio, or transaction or investment strategy is suitable for any specific person. Options involve risk and are not suitable for all investors. Our objective in this video will be solely to talk about buying options, not selling them. We will go over what a strike price is or the agreed price. We will go over both calls and put options. We will also go over what a bid and ask is. And finally, I will explain what exercising an option means and what happens when an option is exercised. Now, if you're watching this video, I am assuming that you're beginning in trading options. Maybe you've been trading stocks for a while, but now you're trading options. I will stay away from exercising. Just letting you guys know, for now in this situation, I will go deeper into it in this video. However, like I said, if you're watching this video, I'm assuming that you're starting off. So let's try to stay away from it as much as we can. In some situations, it is good to exercise. In some situations, it is not, and I will explain why. All right, so what is an option? An option is the right to buy or sell 100 shares of a stock per option when it's at, above, or below the price agreed to, which is also called the strike price. I will be saying strike price a lot throughout this video because we will need to get that pretty much engraved in our brain. That is the agreed price at which we have agreed to sell or buy the stock. Now, there's two types of options. There are calls and there are puts. Uh, a call is a right to buy a stock at or above the price agreed to, which once again is the strike price. You would buy a call if you think the stock is going up. Now, a put is the right to sell a stock at or below the agreed strike price. You will buy a put if you think the stock is going down. Now, you will be hearing me a lot referring to options as different things. And the reason why the way I will do that is because I want to I want to get it through that an option is it could be referred to in different types of ways. Now, another word for an option is a contract, a coupon. Me myself, I call it a bet because it makes sense for me to understand it that way. The price that you pay for an option is the bet that you're willing to make. Now, this contract or coupon has an expiration date. If the price doesn't go above the strike price or the price agreed to on a call or go below the strike price or the price agreed to on a put, they will expire worthless. And this is the risk you take with options. Now, stick with me on this. I will explain everything as we go. Now, remember, every contract of an option represents 100 shares, meaning that each option is tied to 100 shares of the stock. Please keep this in mind as we go through the course. It will all make sense. All right, now I'm going to go into what the strike price of an option is a little bit deeper. Now, once again, as I let you guys know, the strike price of an option is the price at which you, the buyer, have agreed to buy or sell the stock from the seller of that option. Meaning, if the stock is at $5 today and you want to buy a call option with a strike price of $7, that means that you think the stock will go up to $7. And that is the price that you and the seller of that option have agreed to. You're pretty much telling the seller of that option that if the stock goes to $7, you owe me the rights to that stock at $7. Meaning that even if the stock goes above 7 to 8 or 9 or 10, I could still buy that stock at 7 and then resell it at whatever price is at. Now, this is the way you make money when it comes down to exercising. Now, keep in mind, options are trading all types of ways these days. Options are trading for premium, options are trading because they go up and people resell the actual option, like the actual contracts are being, sold back and forth, traded just like stocks. Now, when someone wants to exercise an option, that is pretty much what they do. They would, like, let's say in the previous example, let's say you bought a 7, the stock was a 5, you bought a 7 call and the stock is now at $9. You're pretty much $2 in the money, because from 7 to 9 there's a $2 spread. Meaning you have made $2 in profits, which in real life it's $200 because it is multiplied times 100 shares. Now, I will be explaining in the money and out of the money as we go through the video. I don't really have two, really slides set up for in the money, out of the money, but in the money simply means that you are profitable in your option. So that means that, let's say, once again, in the previous example, you bought the stock was a 5, you bought the 7 strike, and the stock is now at $9. You're $2 in the money, and that is what is called. And the same goes with puts. Like, let's say you had let's say the stock was $50 and you thought the stock was going to go to 40. Whenever that stock goes below 40, like let's goes to 35, that means you're $5 in the money on that put because you're $5 below where you thought that stock was going to be. So that's simply what in the money means. Out of the money means that the strike price hasn't been hit. It hasn't gone above on a call or below on a put. Like I said, I will be talking a little bit more, about it throughout the video. I just want to, that is pretty much like basics of options in the money, out of the money. That is pretty much what it is. Now, I do have a little picture on the right-hand side, pretty much, showing you what in the money is and what in the money is for calls and puts. I didn't put, out of the money. I guess I forgot to actually put that in there. But out of the money is pretty much on calls is the one on the bottom left-hand corner, the square on the bottom left-hand corner, and on puts, out of the money is the square on the top right-hand corner. And that's pretty much. Now, this is the thing, guys, and this is the reason why I actually um, eh, made this picture like this. The reason is because a lot of you guys are trading in Robinhood, and it's always good to have an extra broker. Let it be TD, let it be that's the thing. I only use TD. I love TD. But let it be TD, let it be E-Trade, let it be Webull, whichever it is that you use. The options change, like the option chains are not going to look the same that they do on Robinhood. That is really why Robinhood uh, has blown up because the 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 interface is just so easy to learn. Um, but this is the thing, guys. Eventually, you're gonna like recently there has been a lot of things going on with Robinhoods where they're not letting you buy shares, because of the whole Wall Street thing going on, AMC, GameStop, whichever the case may be. There's always good to have another broker because at the time when GameStop or AMC or Nokia were being restricted, TD Ameritrade was actually letting you buy it. Now, I'm a big advocate of TD Ameritrade. My point is that this is how the option change is going to look. If you look at the picture, of course, it's going to have prices and it's going to have more data, but this is how the option change will look. You have to get used to this unless you want to be, if you want to trade all your life with Robinhood, perfectly fine. But remember, guys, it, it's always good to have a backup plan. That's all I'm saying. All right, so now we'll be going a little bit deeper into call options, into buying call options. Now, one purchases a call option once again if one thinks the stock is going up. Now, in the previous example, let's say you the stock was at $5 and you did your research on the stock, or it's just a stock that you highly believe in, and you will bet your booty that this stock is going to $7 and above in the short term. Let's say a month. Now, you buy a $7 strike call, which is where you think that stock is going to go to, and let's say that call expires, say, in 2 months to be safe, since you think that the stock will go up to 7 in 1 month. Now, let's also say you paid 20 cents for that call, which is usually really cheap. Don't pay attention to my prices too much right now. I will talk about prices a little bit later on in the course. Now, you paid 20 cents for that call, which in real life terms would be $20, since every option is tied to 100 shares, meaning is 20 cents per tied share, meaning the 20-cent bet represents one share times 100 shares. That is $20. Now, the $20 is the bet that you're willing to make that the stock will go above and beyond $7. And this highlights the reason why I try to refer to options as different things. I call it a bet, I call it a contract, I call it an option sometimes. I call it a coupon, whichever the case may be. You're gonna be hearing me do this a lot throughout the video because it's just the idea. I want to make sure that you understand exactly what an option is. Now, keep in mind, there is a lot of factors that go into option prices, like the amount of time to expiration. You got one with 2 months, so I would say 20 a $20 price is a little low. But then again, the stock price is really low as well. So maybe it's at $20. Yeah, maybe it's at $20. Now we will go over the factors that affect the price of a stock option, like implied volatility, the volume that's in that option, the expiration of that option. We will go into that a little bit later on. It's probably, let me see, hold on. No, it's definitely not going to be in this video because I want to be able to get into it deeply. I want to be able to make you guys understand exactly how the prices work. Now, let's say with your option, you have the 7 strike call. You got it when the stock was at 5. You think it's going to go past 7. Now, let's say by the first month, the stock rocketed to $9, and you were right. And once again, we discussed this in the previous example. I'm going to go through it one more time to make sure we understand. Now, let's say the first month the stock rocketed to $9, and you're now $2 past the price that you thought it was going to go to, or pretty much the price that you and the seller agreed on in this situation, which in option terms it means that you're in the money. Once again, you're $2 in the money, which means at this point you could buy the share at $7, then sell them for 9, which will be a $200 profit, of course, minus the $20 that you spent initially on the option. So really is a $180 profit, which is not bad since you only spent $20. Now, in the next slide, we'll be going over exercising options. Now, once again, guys, stay away from exercising options if you're a beginner trader in options. The first thing that you have to understand about exercising an option is that you should not be exercising an option unless you're an expiration date. And the reason why this is because the options have time value under. An option that expires 5 days from now is going to be more valuable than an option that expires on expiration date. So let's say you have an option right now and the option is worth $1, which is really once again $100. And come expiration day, if that option has not hit the money or it's above or below the money, that option is going to be worthless. That option is probably going to be worth like $4, maybe $5 if it has a little bit of time, let's say a couple of hours until the market closes. And that is the main thing about exercising options. We can't exercise options if our contract has time. If our contract has time and we want to take some profit, we sell the contract. That's all we do. We sell the option because if we exercise the option, we're going to be losing that time value on that option. And once again, I mean, I will go over this. This will all make sense. Once again, I'm going to be dropping a lot of courses when it comes down to options. They're all going to be free. I want to be able to provide some value to you guys. All right, so now we'll be talking about buy and put options. Once again, one purchases a put option if one thinks the price of a stock is going down. For example, let's say you're looking at stock XYC, and this stock is currently trading for $50. And let's say for whatever reason, you are willing to make a bet that this stock will go down to 45 in the next month or so. So you buy a $45 strike put expiring in 2 months, since this is the amount of time that you think that put is going to, or the stock is going to take to reach that price. Now, let's say you paid $2 for that option, or for that put option, which means really you paid $200, since once again, it's a $2 bet per share times 100, $200. That's pretty much what you're going to be paying. Now, let's say you were right, you're lucky one, and the stock tumbled down to $32 in the first month of your holding that option. Now, that means that you're now $13 in the money, which means once it reaches 45 to get to 32, that's $13. It's a $13 spread, which means you now have made $1,300. Now, of course, it's $13 that the option will actually be worth times the 100 shares, minus the $200 that you actually initially spent. This means you would end up making a profit of $1,100. And I went ahead and illustrated that pretty much on the right hand side. Now, guys, I will be talking about and this is pretty much to explain, because the process of actually you know the process of actually exercising an option, it's not the idea that I want to get across here. What I want to get across here is that that's how the prices for the options are made. Once you're in the money, that's pretty much how the prices are. Once it's in the money, if you're $1 in the money, that's $100. If you're $2 in the money, that's $200, and that will affect the price of the option, and that's pretty much how the options are priced. Also, now the out of the money options, that's something else. The out of the money options, once again, they're mostly priced on volatility, the amount of people that are trading that option, the amount of time left for those options. However, the ones inside of the money will always have a actual value, which means a intrinsic value. And now I will so I will be getting into this. However, I want to be able to explain intrinsic and extrinsic value. Now, intrinsic value is the real value of an option. So let's say the strike price of the option was $45 and the stock price is now at 43. The intrinsic value of that option, of the real value of that option, is the $200 spread, pretty much the profit there. That is the intrinsic value. Now, the extrinsic value is any other value that's put into that option because of time, volatility, which is how much the market thinks that the stock will go up or down, and volume. That will make the options extrinsic value, or hype value. That's what I want to call it. So in intrinsic value is the real value. Extrinsic value is the hype value, or the uh, speculation value. All right, so I also want to give you a little bit of a history about put options. Um, Put options are usually a little bit more expensive than call options, especially if the stock is going down. Now, the same goes with calls sometimes. However, let me put this in perspective. Put options were initially simply a hedge against a portfolio. So let's say you had 100 shares of a stock. Let's say the stock was Disney, and let's say the stock was trading at $150 per share. And there was a Disney event coming, and you felt that for whatever the case may be, that event may hit Disney in a bad way, and you feel like the stock is going to drop once that event hits. What you can do to hedge or protect, that's pretty much what hedging means, protect your portfolio, is you can buy say the stock is at 150, you can buy a 149 put in case the stock does go below 149, you are protected and you don't lose you don't lose money. The money that you would have lost if you wouldn't have bought that protection. And that is usually what that was originally what puts were for. Now, for this reason, um, people prefer writing calls instead of puts. Not people, market makers. Market makers prefer writing calls instead of puts. That is because they are putting more value in hedging and the protection of it than the speculation of the options. And the speculation is the call side. You think a stock is going to go up. That is simply speculation. And that is that you know that was pretty much that's pretty much what I wanted to bring to you guys. I wanted to give you a little bit of history about it, so you could understand exactly what the put options were originally for and what they actually still do to this day. What people still use them for. All right, so now we'll be talking about exercising options. Now, whenever an option goes in the money, in a call, if it goes above it, in a put, if it goes below the price agreed on, exercising means that you have the right to buy or sell the chosen stock at the price, even if the stock is way higher or way lower than the strike price, since this was the agreed price, or once again, the strike price. And this is technically how options are supposed to make money. Of course, you can also make money once again by trading options with options by waiting for the value of the bet to rise and then reselling that contract itself for a profit. Now, trading options themselves is recommended if you're just beginning. That is what I would recommend. Just trade the contracts. Like I said, don't exercise. If you really need to exercise, um, if you really need to, that you should really need to after hours on expiration day. You shouldn't need to exercise a contract early. There's really no reason to do it, and that would just be a waste of money. You're gonna lose money if you do it. Now, keep in mind, you can only exercise an option if the option has reached, or if the stock price has reached the agreed price. You make your money back or break even, which is what we usually call it, what you'll see on all of the platforms. You'll be break even once the stock goes over the price and goes to the bet that you placed over it. So that's on a call side. On a put side is when it goes below the price and it goes to the bet. It goes a little bit below so it goes below and it goes until the bet that you actually placed on it. So let's say you did a $45 strike call, the $45 strike put, and the previous example, the stock was at 50. You bought a $45 strike put, and you paid how much did you pay for that option? I think you paid $2 for that option. Wait, did we pay $2 for that option? Yeah, we paid $2 for that option. Now that means that your break even price is $43 because 45, 44 you made 100, 43 you made 200. So that is your break even price. That is what you paid for. That is when you get your money back. In a call side, you would have made your money back. On our previous example, the price was at 5. We made a $7 strike bet, and it our break even price, we only paid $20 or 20 cents for that option. So our break even price would have been $7.20. When that price got to $7.20, you made your money back in intrinsic value. So in real value, you made your money back. Of course, there's going to be a profit on the contract of that option because of what I mentioned: volatility, time to expiration, volume on the bets, things like that. See now, guys, exercising options can be helpful in some situations, but once again, as a beginner trader, I would just recommend staying away from it. That's all there is to it. That is all there is to it. All right, so now we'll be talking about the bid and the ask on an option, and that is directly related to the price of the option. Now, the bid price of an option is the lowest price that investors are willing to pay for that option or that bet. The ask price of an option is the highest price the seller is willing to sell it for. If you put in an order to buy an option and you want to get filled right away, you need to buy it at the ask price. You need to buy it where all of the sellers are at the ask price. If you need to sell an option that you bought, so let's say you have a contract and you have some profit on the contract and you want to sell it, the quickest way that order is going to go through is if you sell it at the bid price where all of the buyers are at. So that's pretty much the idea of the bid and ask price. Bid and ask will change as the stock moves, of course. As long as there is demand, I apologize, as long as there is demand for that option. If the option is not traded, you will most likely see a bid of zero since no one is willing to pay anything for that option. Now, the spread of an option price is the distance between the bid and the ask. Now, let's say the spread is less than 3 cents. So let's say the bid is at 80 cents and the ask is at 83 cents. You're most likely trading a liquid option, meaning that if it will be easy for you to get in and out of trades on that option. Now, when the bid and the ask are more than 5 cents away from each other, maybe, I mean, that could vary. It could be 5 cents. I would say maybe 10, more than 10 cents from each other, say 10, 20 cents. Then it is likely that you are trading an illiquid market, meaning that it will not be easy for you to get in and out of those trades unless you sell it at the bid or ask, unless you set it at the bid or you buy it at the ask. We usually like to buy in between. So let's say the bid is at $5 and the ask is at $10. We like to buy it at 7 or 8, so we could get a good deal on that option. So that is pretty much it. So I illustrated this for you on the right hand side. On the left hand side, remember, guys, I'm gonna make sure you learn this because I know there's traders out there that don't know how to use any other platform. And this is exactly how those option chains are going to look on another platform. So on the right hand side, I give you a little bit of an example as far as to what a liquid option chain is and what an illiquid option chain is. So on the left hand side, you see that every option on the left hand side, let's say the calls have a 2 cent spread. Like if you look at that $5 strike call on the left hand side is 105 for the bid and 107 for the ask. That means that there is a 2 cent spread under, which means that very liquid. You're going to be able to get in and out really quickly, and you're probably going to get filled at 106 since that's the mid price. Now, if you look over, and same goes on the puts. If you look at the put side, it's a very liquid option. There's like 2 cents in between the bid and the ask, so it's really easy to get in and out. Now, if you look at the right hand side, let's say we look at that same $5 strike price, you see that it's 105 for the bid and 157 for the ask. So that means that if you want to get that stock, and I mean, if you want to get that option, you have to pay 157. You have to pay $157 to be able to get filled right away, or for that order to go through right away. If you put in that order at 105, I mean, you're probably going to get filled eventually. However, you don't want to be letting options sit there. You don't want to be letting option orders sit there. Because let's say you put in an order at 105, a call order at 105, and the stock drops. And let's say you're like, hey, yeah, it's going to be filled throughout the day. And that stock drops, and let's say that stock goes down to $3, you just lost all your money. Because that stock with that option would have gotten filled at 105. Say it would have gone down to $3. That stock option would have really been worth, say, like $18. So it went from 105 to 18 cents. So from 105 to 18 cents. You're gonna get filled because someone's gonna see that you're bidding 105 and they're gonna sell it to you. And as soon as they sell it to you, your option is gonna go all the way down. And that's why that's something I want to get across. I don't like putting in orders for them to get filled in the future. It's just not something that we should be doing because options are very volatile and very risky. And that's the main point that I wanted to get across there. All right, so what is next? Next, we will be talking about option Greeks. Option Greeks are pretty much the technicals of the option, pretty much what makes an option price. What happens, it will give you data as far as to what will happen whenever the stock goes up $1 or whenever the stock goes down $1. It will tell you data as far as to how much money you're losing a day for holding that option. It will tell you data as far as to how much money will rise for volatility percentage. It will tell you good data, and I will make sure I go into this exactly like I went into everything today. This will probably be one of the most challenging parts, I would say, about trading options, because I really think I can make everything else seem really easy for you guys. Delta, Gamma, Theta, Vega. Those are the Greeks of an option. I will go into them. I will make sure you guys understand this. All right, so thank you guys for tuning in. I really appreciate you, anybody that watched this video. I'm gonna be bringing more videos like this to you in the future. Make sure to subscribe, turn on post notifications so you get notifications as far as to when those are coming out, and also make sure to drop a like for me if you enjoyed the content. I will make sure, guys, ultimately that I'm gonna drop a lot of videos, guys. So I'm gonna be talking a lot about TD Ameritrade, and I'm pretty much I'm gonna try to speak mostly to the newer generation of investors that is coming into the market now, because I know a lot of people. I know a lot of people probably feel stuck right now with one broker, because one broker makes it seem so easy to do things. Things are easy to do on another broker, guys. It's just a matter of actually learning these things out. I will drop a course on TD, Thinkorswim, whenever I get a chance. I will make sure. Once again, I'm as specific as I was on this course about everything. And I will also get deep into we will be getting deep into options. We will make sure we understand, by just looking at an option change, what the sentiment for that stock is. How many options were sold that day, how many calls were sold, how many puts were sold, at what price they were sold generally. What was the Greeks of that option? And at that point in time, you guys are going to be with me as far as Greeks go. You will understand. I will make sure of all of that, guys. Thank you so much for watching, guys. You guys have a wonderful day. Stay safe out there with all of this crazy stuff. Make sure you stay safe. Wash your hands. Stay sanitized, guys. I love you guys. See you on the next video.